Hello everybody. July so far has been pretty quiet, so I was just waiting for the results of the REITs issue to come out, and it came out this week. So in the end, what happened was that the REITs ate up all my cash pile. So all the cash that I was holding on to, waiting for collapse in the later half of this year, disappeared. So I applied for my entitlement plus a lot more access rights for IREIT and CapitaLand India, because I think the rights price is just too attractive. For IREIT it's at 40.8 cents, which is pretty much the all-time low, and for Clint it's at 1.06, which is also pretty much near the all-time low, but not at the all-time low though. So in the end, what happened was that I got everything that I wanted, including all the access rights, which surprised me actually. Actually I applied for a lot of access rights, and I got all of them, which is a good problem to have actually, because if you look at it, all my access rights are in the money. For IREIT it's at 43 cents versus the issue price of 40.8 cents, and for Clint it's at 1.16 versus the rights price of 1.06. So it's a matter of whether or not I want to sell the access rights to lock in my profits. I think I might do so for Clint, but after thinking about it for a couple of days, I think I'll keep all my access rights for IREIT actually. I think there's gonna be a whole bunch of other retail investors who just dump everything off to lock in their profits. I think at current levels, this stuff is actually very cheaper. So I think I'll just keep everything and just collect the dividends actually. For IREIT, I think the news release this week has been pretty positive. Previously, the major concern was about the expiry over here in 2024, and look at it, it's pretty chunky, right? 30%. It's all coming from a property in Berlin. So if the tenant vacates, you're looking at a 30% drop in revenue, right? So post acquisition, this concentration risk goes to 28%. And this week they announced something which is pretty interesting. I think it's pretty positive for the REIT actually. The tenant, which is occupying the current property, has extended the lease by 6 more months, which is well, no big deal. But I think this stuff here is more interesting. The revised rent is going to be 45% higher than the current rent, right? So previously the manager has guided that the property is currently under rented, and that the current rent is much lower than the market rent. But of course there's always some doubt, right, whether or not the manager is saying the truth or not. But I think this action suggests that the what the manager is guiding is actually quite truthful, that the current market rent is much lower than the current rent is actually much lower than the market rent. So I think if the tenants really vacates, it's not that bad news, because if the manager can reposition the asset to rent it out to other tenants and they pay a higher rent, then the eventual revenue might even be higher. This stuff here is also pretty good. So if the tenant really decides to vacate, they're gonna have to pay 15.5 million euros. So that's around 16 months of the current rent, right? So this is gonna be quite a substantial amount of cash for them to reposition the asset and to re-let it out to other tenants in the event that the current tenant vacates. So we have to wait and see. But look at it, if the tenant really does vacate, you have this sum of money. Maybe some of money will need to be used to reposition the asset, and some money might be used for capital top-ups in the event that there's going to be MPI void gap. So I think the current news announced is pretty good actually. Allays a lot of the concerns surrounding this major expiry. In terms of valuations, I think quantitatively it's actually looking very cheaper. If post the acquisition, DPU is 2.3 euro cents, and the NAV is dropped to 50 cents euro. If you convert it to Sing dollars using the current exchange rate of around 1.48, you're looking at the valuation of 8% dividend yield with a gearing of just 33% and trading at 0.6 of price to book. I think this is looking very attractive actually. If you look at the how it's valued versus the rest of the stuff in the markets right now, and especially given that the pro forma illustration is based on the assumption that the Darmstadt campus is 100% vacant, right? Which is not true actually. They've managed to lease some of it out, not the entire campus, but some of the campus out already. So actually this number is a bit of a understatement. So the 8% yield is actually understated, I think. Might be higher in the eventual results to come up. I think the main thing concerning this REIT is the FX impact, because all the assets is in euro and the DPU is in euro as well. But if you look at the trend of the euro Sing FX post the invasion of Ukraine by Russia, Euro has fallen from 160 to around 140 against the Sing, right? And recently it has bounced back to 148 to 149. And I think the Euro is actually on an uptrend, because if you look at it, the Fed is pretty much close to done, right? Maybe one more hike, maybe two more hikes, and it's pretty much done, I think. I think we've seen the peak of the Fed rate hiking cycle. It's just a matter of how long they keep the rates there. I think the ECB is not done against the inflation fight though. The inflation in the Eurozone is still too high for the ECB to stop its hawkish stance. So I think the US dollar, will begin to fall. And I think the euro will begin to rise. And therefore, I think the euro Sing might be outperforming against the Sing dollar, which pretty much translates to better translated DPU and NAV for IREIT in Sing terms. So I think based on this reason and the reasons I talked about earlier, I'll just keep all my excess rights and enjoy the 8% or even higher dividend yield for the next 1 or 2 years.